You've probably heard the saying, don't put all your eggs in one basket. Well, in the world of investing, this is more than just a saying, it's a strategy. Hello everyone, this is CA Twinkle Jain, and in this video, we'll dive into what diversification within mutual funds means and how you can achieve a balanced investment portfolio that aligns with your financial goals. First, let's start with the basics. What is diversification? In simple terms, diversification is the practice of spreading your investments across a variety of assets to reduce risk. The idea is that by investing in different types of assets, you can minimize the impact of any single investment's poor performance on your overall portfolio. It's like creating a safety net for your investments. Now, you might be wondering, why is the diversification so important? The answer lies in the nature of financial markets. Markets are unpredictable and the performance of different assets can vary significantly. For example, during a market downturn, stocks might perform poorly, but bonds or gold might hold their value or even appreciate. By diversifying your investments, you reduce the risk of your entire portfolio taking a hit if one asset class underperforms. So, how do you achieve diversification within mutual funds? Let's break it down. First, diversification across asset classes. The first step to diversifying your mutual fund portfolio is to invest in different asset classes. These typically include equities, debt, and cash equivalents. Equities tend to offer higher returns but come with higher risk, while debt instruments provide more stable returns with lower risk. By including a mix of both, you balance risk and return. For example, if you're a young investor with a high-risk appetite, you might allocate a larger portion of your portfolio to equity funds. On the other hand, if you're nearing retirement, you might prefer a more conservative allocation with a higher portion in debt funds. Second, diversification within asset classes. Once you're decided on the mix of asset classes, the next step is to diversify within each asset class. For equities, this means investing in funds that cover different sectors, industries, and geographies. For instance, you might invest in a large cap fund that focuses on well-established companies, a mid-cap fund that targets companies with high growth potential, and an international fund that gives you exposure to global markets. Similarly, for debt, you can diversify by investing in short-term, medium-term, and long-term bonds, or by including both government and corporate bonds in your portfolio. Third, diversification by investment style. Another way to diversify your mutual fund portfolio is by investment style. Mutual funds can follow different strategies such as growth, value, or income. A growth fund focuses on companies that are expected to grow at an above average rate compared to others. A value fund, on the other hand, looks for companies that are undervalued by the market but have strong fundamentals. An income fund invests in securities that pay a regular income such as dividends or interest. By mixing these styles, you can reduce the impact of market fluctuations on your portfolio. Fourth, diversification by fund managers. It's also a good idea to diversify by fund managers. Each fund manager has a unique approach to managing investments. Some might be more aggressive, while others take a conservative approach. By investing in funds managed by different fund managers, you benefit from a variety of perspectives and strategies which can enhance your overall returns. Now that we've covered the different ways to diversify, let's talk about the benefits of diversification. First, risk reduction. The primary benefit of diversification is risk reduction. By spreading your investments across various assets, sectors, and geographies, you reduce the risk of a significant loss. For example, if one sector underperforms, your losses can be offset by the gains in another sector. Second, smoother returns. Diversification can help smooth out the volatility in your portfolio's returns. While some investments might experience short-term losses, others might gain, resulting in more stable overall returns. Third, access to a broader range of opportunities. Diversification allows you to tap into a wide range of investment opportunities. By including international funds, for example, you can benefit from the growth potential of emerging markets which might not be available in your home country. Fourth, peace of mind. Finally, diversification gives you a peace of mind. Knowing that your investments are spread across a variety of assets and strategies, it can help you stay calm during market downturns and prevent impulsive decisions. Now, while diversification is a powerful tool, it's important to remember that it's not a guarantee against loss. Even a well-diversified portfolio can experience losses, especially during the market-wide downturns. However, over the long term, diversification has been shown to improve the risk-adjusted returns of a portfolio. So, how can you implement diversification in your mutual fund investments? Here are a few tips. First, assess your risk tolerance. Before diversifying, it's crucial to understand your risk tolerance. How much risk are you willing to take? This will determine your asset allocation. If you're risk averse, you might want to allocate more to debt funds. If you're comfortable with risk, you might lean more towards equity funds. Second, regularly review and rebalance your portfolio. Diversification isn't a one-time task. As market conditions change, the performance of your investments will vary, causing your asset allocation to drift from your original plan. It's important to regularly review your portfolio and rebalance it to maintain your desired level of diversification. Third, consider your investment goals. Your investment goals should also guide your diversification strategy. If you're saving for a short-term goal, you might prefer a conservative portfolio with more debt funds. For long-term goals, you might opt for a more aggressive portfolio with higher equity allocation. Hope you found this content helpful. Stay tuned to our channel for more such informative videos. This is CA Twinkle Jain helping you make smarter investment decisions.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.